trend day, which is something I as an intraday trader live for. So I was happy today. Not everybody was, of course. Just always remember there's people on the other side of your trades, so when we're happy, other people sometimes aren't. But it's the market, and so a lot of bigger moves happen when one side of the market is trapped. So I'll make this an interactive presentation, and looking forward to being with you all. Thank you all for the opportunity. The sector rotation model, it's big words, it's just big concepts, but this was what bridged the gap in my trading. So what I'm talking about here is not something I discuss a lot publicly because it's a kind of a complex topic, but as James and I were talking earlier, this kind of brings our perspectives together. And he'll talk about the options, how to actually use this and put it to work with money flow. What we're doing at the core is tracking the big traders, tracking the funds, looking at what they're doing, and following them. So our probability, just putting the odds in our favor, probability and the chances for success, if we identify trends, which is the first thing, is the stock market rising or falling or transitioning, rotating, going from bull to bear, etc. And then with confidence, what can we do? The big elephant, track the elephants in the stock market. So we're not going to make market action or movement. We're not going to be able to affect Fed policy or reverse a bull trend to a bear. We can't let our hopes and fears and dreams and wishes affect everything. We just got to figure out what those big people are doing and essentially go with them. That's true for a swing trading perspective. It's also true for an intraday perspective. So as we jump on in, again, I started my career in, which I'm in the slide. By the way, all trading does involve risk. I wish that it didn't. I wish that every single day was just perfect, but it's not. We know that as traders. And that's the more you trade, the more you realize that a lot of what you do is risk management and opportunity maximization. Focusing on the probabilities, focusing on your edge, finding your edge, the odds in your favor, and then going with that with a risk-controlled parameter. And I may have heard recently about the trader who went short that biotech stock, and I think the account was about $34,000, woke up the next morning, the stock was about $1, and I think the stock was about 10 or so, and he was out of money, $100-something thousand. So it was about a 3-time, 4-time account value, oopsie, to say the least. So let's hopefully not have that happen in terms of risk management. All right, so this is, again, sector rotation and just money flow strength, weakness, relative strength. This is the concept that bridged the gap between fundamental analysis, which is the what are we trading? Why are we trading this? What stocks have good fundamentals? What stocks have good earnings? Is Netflix better than Amazon? Is Google, or Alphabet now, is that better than Yahoo? Or is Netflix better than etc.? Is Chipotle better than McDonald's? They're both fast food companies, but all that. So that's bridges a fundamental analysis perspective with the technical, which is what I became very enthralled with in about 2003. That's when I became a swing trader, from fundamental investor over there to the swing trading world. Got involved with the Trading Expo and met a lot of people in contacts and have really just plunged into this chart world, analytical world, and entered Trader 2015. And everything else has gone from there. So that's, again, this was the foundational concept that helped me to identify what stocks to focus on, when I'm doing a stock scan, what do I care about, which stocks are important, and it cuts through the noise. You may have 100 stocks to look at, but which ones are important to you? So sector rotation was that model that helped do that. I hope that can do that for you. If not, take a couple of points of view into your own trading practices. So as James so kindly said, the CMT is that mean old 2-year program, but it's where you have to learn about everything possible, just about, from Elliott wave to Fibonacci to moving averages to MACD, you name it, we had to learn it and study it and put it up on a test and do a written test as well. So I'm very happy and proud to have achieved and honored the CMT designation about 6 years ago now. And I've been running the Afraid to Trade website publicly since 2007. When I became a full-time intraday trader. So that's a little bit of background on me. And one of the happiest moments is moving to Los Angeles, California. So that's where I have based my trading activities and headquarters now. I've been here about 2 years. And Alabama's great, where I'm from. You may hear my southern accent, but LA, a lot different life. So again, just my background in terms of relating is just institutional investor into swing trader into what now is day trader. At the bottom, I'm a swing ETF person using these strategies for my retirement accounts and longer-term portfolios. So I do use these tactics actively, not as much as an intraday tactics. So these things are not things you mess with on a daily basis. They're salient, they last, and they help you. And of course, futures and stocks for the intraday world. I like trend days. So today was one of my favorite days, and it keeps me busy. All right, so again, we'll go through new questions as we progress. I want us to be interactive. I want us to be just talking at you. I want to work with you and teach and instruct things that have been good for me, things that have been confusing, and things I wish I knew at the time. I'm here to help you with that as well as we go through. But this is some of the quotes that we do. We're in the market to make money. That's just it. We're here to make money, not to be to whatever the other motivations are, making money efficiently and with a risk-controlled maneuver. Yeah, in terms of Daniel asked, did I trade the futures today, capture the big move? Yes, and I'll explain that later. Trend days, this is what I was forecasting. I gave a market panel forecast on Monday, and also I do the TradeStation morning briefing on Tuesday morning. So at 2 different public forums where I discuss why I thought the market was headed down. And so all it is for me, my strategy is analyzing and setting the play up, game planning, and then execution in the intraday environment, be it a trend day like today, where my focus is, or a range day. So yes, the analysis was correct. The strategies and implication were there, or application was there. So that's the style of trading I do. It's a lot of setting up bigger picture concepts, money flow, sector rotation, with an execution either on the swing trading environment, and James will go through this later in terms of using options and strategies to actually do these things, or of course the intraday environment. But these quotes help me always. Peter Lynch said, if you're in the right sector at the right time, then you can make a lot of money very fast. And I agree with that. And the key thing, Peter Navarro, if you do have more interest in this topic, Peter Navarro wrote a book, If It's Raining in Brazil, by Starbucks. Also, If the Market Moves, or When the Market Moves, Be Ready. 2 books by him that really goes into this concept. And of course, Sam Stovall, lots of other background reading on sector rotation. It's a topic that isn't just a random thing, it's a salient concept. So the principle is this as we go through. Buy strong stocks in strong sectors in a rising market, or sell short weak stocks in weak sectors in a falling market. And you can also do hedging strategies, and options are a perfect vehicle to set these up as needed. So what we'll do, we'll focus on 3 things and only 3 with the time we have together today, which is the first thing. I think this is the big question. Are we in a bull market or bear? Right now, end of 2015, are we transitioning to a bear market? Yes or no? Sector rotation can give you some clues about that. So we're looking at where the market cycle is currently, bull, bear, and what the future can be. So it's a pathway based on big trader performance at certain points in the cycle. Knowing that, starting with that, we're going to, as an investor or longer-term trader, invest in these top sector ETFs. List is down here, just a few of them, just to make a list. And then I think this is probably more appropriate to this style of group of traders, and in my membership as well, which is we will, with these things and the wind at our back, not just being random, we're going to look at the strongest stocks, fundamentally, technically, uptrending, whatever the case may be, your strategies, in the strongest sectors in that rising market. So that's what we're going to focus on. It's just determining bull-bear cycle and then looking at the sector ETFs or just focusing on intraday opportunities in them. It's just putting the odds in your favor with this concept of money flow, big participants, big funds, hedge funds, big banks. They do certain things at certain times, and we ride their coattails playing in these names. Love these quotes too, and I can vouch for this, but most traders can. An expert's a person who has made all the mistakes that can be made in a very narrow field. So I've done some bad things in my trading, I've done some good things, but everything we do bad and survive, we become better. That's kind of the goal. Every day is a learning experience. And I love Niels Bohr. Predictions very difficult, especially about the future. And so that's what sector rotation helped bridge the gap, for me at least. It's focusing on money flow, and I guess James will go into that in more detail. It's focusing on price movement and big actors in the stock market doing and investing, doing their activities. So that's what we do. So what we kind of moving quickly, stock market's either rising or falling or transitioning, so bull or bear market or flat market, which is a transitional market. The sectors, there are at all points in time in that cycle, strong sectors and weak sectors. And at all points in time in this model, there are strong stocks and weak stocks in that. So we'll focus on this as we go through. And just to be laser focused, just for an example, to clarify, you can trade the S&P. You can look specifically at financials using XLF or other ETFs, leveraged ETFs for that matter too. And you can focus on individual names, Goldman, Citigroup, Visa, just to name a few. So here's the bigger picture in terms of the sectors are made up of little tiny groups, little industries, and these industries have stocks in them. So this helps you put your trades in a context, not just, oh, it's a bull flag in MetLife, or it's a bear flag in AIG, or whatever the case may be. You've got the stock market trend, you've got the sector performance, strong or weak, and then individual names, which are opportunities to trade. So just what is this whole sector rotation thingy? It's the concept that it's historically tested. There's white papers on it, there's research papers on it. I've done my fair share of research and, of course, trading performance, but it's the concept that certain sectors outperform or underperform other sectors in specific stages of the market cycle. During a transition from bear to bull, early bull markets, certain things do well. Financials and technology, for example. At the middle stage of a bull market, certain things do well, industrials and materials. At the end of a bull market cycle, energy tends to do well. And as we transition from bull to bear, we look at staples, healthcare, and utilities, just to name a few. So not only does it tell you where to be, but where we are right now, based on what is doing well, overlay that with the model, and it tells you what's next, what's probably coming next, based on what the big boys, the big traders, the big funds are doing with their capital. Are they offensive, bullish, confident? Are they defensive, bearish, protective? That's what we're doing. It tells you where we are in the bull market, bear market, or transitional cycle. But beyond that, gives you a roadmap of which sectors and stocks to put your money, to trade, to use strategies, to swing trade, or maybe even to intraday trade. So that's the model, that's a focus. Bull market, bear market transition, looking at the sector performance and then the stocks within. And if you're trading, if you're investing, rotate capital. And these things move in a relatively predictable, not everything's perfect, stable progression. So as one tends to rotate out, rotate your capital there. Rotate your attention to the next one. All right, so just quickly moving through, there's an early, in terms of this is the business cycle, the economy, there's early in a recovery, think back to 2009, think also back to 2003, there's a middle recovery, think back to 2005 and 6, also 2010, 11 potentially, and then late recovery, or the peak, think of 2007. And then, of course, recession, 2008, late recession, late 2008, early 9, and, of course, the trough, 2009, and up we go. That's the cycle, the most recent one. The stock market has other things, which is we don't call it early recovery, middle recovery, late recovery. We call it bottom, top, early bull, middle bull, late bull, and then other terms you could use is accumulation, markup, distribution, mark down, accumulation, bottom, early bull, etc., etc., etc. And these things overlap in this form and function. So the stock market actually leads the economy. It's just a historical fact. It just does in terms of performance. The stock market will peak ahead of a recession. The stock market will bottom ahead of an official declaration of we're in recovery. Stocks tend to be an anticipatory vehicle. So looking at the stock market, what the big funds are doing, where the volume is flowing, where the performance is, that will give you clues as to where we are in the economy. So this, so far, making sense. I want to make sure we get all the kind of concepts in there. Everything making sense so far. We're going to start looking at these things. So good. Yes, perfect. Perfect. Dennis said perfect. Good, good, good. Yes, okay. Yeah, I like that. All right, sweet. All right, so moving again, if you have questions or anything at the time, let me know. Joe says good too. So perfect. Again, conversation, not just a talking at you here. I definitely make this interactive as much as possible. So that's what we're doing. This is what bridged the gap between what's the economic rate, what's the unemployment, what's all these complicated statistics and figures and fundamental analysis, and the stock market. How do you put it together? To me, this was what made sense and what kept everything into a consistent vehicle for active performance, active trading, and of course investment. So without giving too much detail of this chart, again, stock market bottom accumulation, bull market markup, top distribution, bear market markdown. So we're still in this. This is a chart that I did a few years ago. We're still in this bull market markup. Potentially top distribution, but at this moment it looks like we're still bull market markup in terms of bigger picture concept. Today may see things differently, but still, this is how the market cycle moves consistently. In terms of sector rotation, this is the ETF performance, ETF level. You want to, again, this is not enough time to go through this in this presentation, but again, lots of resources, information on this. Things that do well in the early part of a bull market, again, retail, housing, automobiles, technology, that people have been holding out and be conservative during the recession or the bear market, and so they start to release their capital. And businesses expand. They buy new computers. They actually buy homes, and interest rates are lower, so on and so forth. And this starts to cycle afresh. And as the market cycle increases, technology moves to industrials. These things outperform the market. You see certain stocks, Caterpillar, other things too, materials, mining stocks, silver stocks, etc. Those are up here. And then at the middle bull, late bull, you see energy, not a good sign. And then as it rotates over, consumer staples are the top performer. These are defensive. As we go through, these are offensive. Offensive meaning they do well during bull markets, economic expansions, and good times. And the funds are bullish and they're aggressive. They pull their money back. They still have to. Keep in mind, why do certain things do well during bull markets, and by well meaning not fall as fast? By charter, hedge funds, or at least investment funds, mutual funds particularly, have to allocate capital. Retirement accounts can't really go short. Most of them can't, that is. And so the money tends to flow to defensive names with higher yields or protective stability, healthcare stocks, utilities mainly, and consumer staples. Things like toothpaste, things like food stocks, things that you have to have, even beer. Coors and Miller and all these things, Bud, these stocks do well because in a recession, we typically do things we have to have. And then the seems to early bull. Yeah, Tim asked, we seem to be in the early bull stage. Yeah, no, because this bull market's been going since 2009. I wouldn't call this early bull. I would say, if anything, if I had to, I'm not giving too many secrets away, but I'd say we're probably middle to, we're probably in this area, middle to late. Yeah, financials doing well, tech doing well too, but it's very difficult to call a bull market new when it's 6 years old. This bull market began March 6th or 9th, depending on how you do it, in 2009, and we're about to transition to 2016, so wouldn't just by definition call it early, probably middle to late, just to give a sense of that. All right, so just quick. Relative strength, this is the XLE, Energy ETF. This is XLP Staples. Let's go back to this real quick. Consumer staples do well once the market has peaked into the early recession, and then, of course, staples and energy at that point, so early bear. Stocks peaked, this is going back to 2007. Stocks, actually, we don't know this in hindsight. We know it in hindsight, not in real time. But then what did well? Energy kept going higher. Energy kept going up until June and July of 2008. Energy stocks, ExxonMobil, Chevron, etc., in the cycle, they actually topped mid-2008 after the market peaked. And of course, what happened next? This is XLP Staples. Staples actually peaked in September. We're about to fall off a cliff. We don't know this, of course, at the time, but looking at the sector rotation model, this was showing us we are right here. We are there. This is where we were, and of course, you know what happened next. And these things rotated further in 2009 forward. So kind of quick look at that. There's all kind of charts to go through, but this is how it works. So what's the market doing? What sectors are outperforming the market, and which ones are underperforming? So given this type of structure, divergences, breadth deterioration, all sort of things taking a turn to the worse, energy peaks later, staples peak later, and the market then has well since topped. So anyway, your symbols, you can do a screen capture in the recording. Take a look at this. F for financials, XLY. These are things that I use. You don't have to use these. You can use individual ETFs, leverage ETFs. These are just the ones that are sector spiders. AMAX sector spiders just for helpful reference. Of course, Y technology, K technology, industrials, materials, energy, so on and so forth. And there they are, kind of a cheat sheet for you. What I'm doing, I do public blog posts for anybody and everybody that we compare sector performance, either bigger picture or intraday. This is the model that we use. These 5 are bullish, offensive. Energy is kind of off to itself, and these 3, staples, healthcare, utilities, are defensive. If I'm seeing today's session, just take a guess. What were the top performing sectors today? What do y'all think? It was a big down day. Which ones outperformed? Not that there was much up today, but they were, yeah, exactly. There was the same thing. So it's these things. These outperformed, quote unquote, the market on the XLP, V, and utilities. So moving forward, this is a chart of what I do with the Afraid to Trade blog for you, just public chart analysis. And if you're looking at the sector, this is a couple of days ago when the market fell. It was a downtrending day, but I published this midday to show what I expect or what's looking out for the future. So forget all this data. This is what's going on. So midday, right here, take a sector snapshot, and it shows staples, healthcare are the strongest sectors of that session. In fact, let's see, about 70% of healthcare stocks were up in the S&P, 86 staples. That tells me probably, well, A, we have defensive money flow. That's you can see that in price itself. But probability is the market will keep going lower. So I want to be a bear the rest of the day. And of course, after a little bit of a hiccup, the market closed at the lows. So sector rotation is both a macro big picture thing, but also a short-term intraday, follow the money, follow the performance, and that helps you as an intraday trader. Which sectors, which groups are doing well and which aren't. And so this was today's session. Woo! Today's session is December 3rd. This is a big, obviously, down day. And this is from finviz.com. Multiple websites do this, and of course this is part of the membership and the blog as well, looking at sector performance and giving a analysis of that, what stands out, what does it say, what does it predict, how can we use it, more importantly, in our decisions. So everything is down. One little pocket of strength, that's not that it matters necessarily, but was your discount variety stores, Costco, Target, Dollar General, and Walmart. What you don't want to do in terms of sector rotation is find the pocket of strength in a sea of red. You don't want to find the little sparkling gem in the midst of a sea of selling pressure. This type of session should make you bearish non-stop. You do not want to be buying stocks that are bucking the market's trend. You're essentially, if you're doing that, you're fighting big money flow, banks liquidating, hedge funds, whatever the case is. You don't want to do that. Find what the market's doing, find the trend, and jump into, align yourself with that trend. So for example, even if you were perfect, Costco is up 2% that day, Walmart 1%. Over here, biotech, Amgen, down 3.5, Gilead, down 3, Celgene, 4. Et cetera, et cetera, et cetera. All these things. Apple was down 1, Facebook down 2. But your biggest pocket of weakness was over here. So focus on, that's what I'm, down day, focus on the weakest stocks and the weakest sectors. Or if it's an up day, focus on strong stocks, strong sectors. And Mark says, guess I got lucky getting out of my KR call today. Yeah, today was just an icky down day in the market. And most, if not, just about all stocks fell in that. Finishing up, sector performance is not just some random thing. It's not just something we look at and kind of move away from. This is a presentation I did back middle of the year for a small group, and this is a chart that I showed. I showed this for the exact reason to show what I discussed in this presentation live back in June, July, May. This continued. Discretionary was the strongest sector back then in terms of performance in the S&P, and energy was the worst. So again, this is the S&P, the red, best performer, XLY discretionary, worst, XLE energy. Let's look at today. That's today's session from stockcharts.com. What is, and still is the best sector? Discretionary. What's the worst? Energy. So these are, again, this is about a year ago, less than a year ago, and the same concept is at play. The best is still discretionary, the worst is still energy. So when you find a sector trend in terms of market performance, you want to stay with it and have confidence in it, trade in the direction of the sector performance, and don't fight it. Don't think that, oh, because energy, which is tempting, I understand that, but because energy is so beat up, or gold is so beat up, or whatever the sector may be, I'm going to go long and call the bottom. That typically doesn't work. It's find what's strong, join strong stocks and strong sectors, and find what's weak and either avoid them if you don't short, or short them and go with that. Don't try to bet on these trend reversals. More than not, they don't work for the big picture. So finishing up, we'll take questions. I think we're going to do a joint question at the end, James and I together. I'm going to transition him shortly. But the big picture for the sector rotation model, use this if you're an investor, if you have a retirement account, or you're not an active intraday trader, which I assume most of you are, and of course I am too, but if you don't do that, you can use this model to assess where we are and then position your portfolio appropriately in terms of sector performance, where you're going to overweight your portfolio, underweight what stocks, etc., and then go with that. If energy is really doing well and we've had a bull market for 7 years, be defensive, definitely. If the market's been bear market for 2 years and you're starting to see financials and technology do well, maybe it's time to rotate money out of bonds into stocks. So it's a broader picture concept. And the same thing. Traders can trade these, identify and trade swing trading with options, different strategies, straight up pull or put or a straight up call, either one. Strong stock, well, if you're trading weak stocks, weak sectors. Strongest stocks, strongest sectors using TA. It can be as simple as a breakout, a flag. It doesn't have to be complex. Just find the money flow, get in with the money flow. Don't try to be perfect. Don't try to get this absolutely exact trade location. Make sure all your indicators are lined up perfectly. Get in with the money flow and go with that. It tends to help your performance. And if you're using options as a hedging strategy or just an outright pairs trading or hedging in the sense, you can actually, in directional neutral, buy strong stocks and strong sectors at the time based on the model, and then hedge with options or just short sell weak stocks and weak sectors. It's kind of a defensive or market neutral, to an extent at least, way to use the model. So finishing up, 3 things that help us is that we know where we are in the cycle, bull, bear, reversing, invest in the top sector ETFs. Beyond this, bull market, focus on your best sectors at the time and what probably will rotate up next. And I think this is probably most important, most fun at least. Trade those strong stocks in those strong sectors in a bull market, or trade those weak stocks, weak market. By the way, how many people would have done well short selling financials and technology stocks in 2008? Model called that. That was exactly what the model would have called, because that's, as the market rotates, those things do poorly. So it works in terms of what's weak, what's out of favor in a bear market would be in favor in a bull. So think of it as a little seesaw type thing. I think it helps your trading. It helps mine at least. So these are, I guess, for the recording. Sector investing, Sam Stovall, Peter Navarro, if it's raining in Brazil, buy Starbucks. When the market moves, you'll be ready. And then Martin Pring, I love Martin Pring's work. He did publish a book called The All Seasons Investor, and then Super Sectors by John Nairati. So just those are books if you want more information. And I do lessons as well. So we'll discuss again at the end, but in terms of what I would like to offer you for your attendance and for learning more and getting more in detail with this is actual 2 months trading with me, 2 months looking at kind of over my shoulder as we analyze, set the gameplay up, set strategies up into December, into January. So you'll have the holiday there. And I also do teaching, education, as we do in the reports. It's daily commentary and bigger picture concepts, sector rotation, strength, what to look at, what stock scans I'm interested in, what tactics we're employing, and where to go next. In addition to the membership, 10 lessons. So this is going to be in the chat box at the end of the presentation, but that's a direct link for $97. Kind of a holiday thank you for you all. And I want to transition over, again, we'll be doing questions at the end of it there. For James, my good friend James, looking forward to hearing it. He's going to tell you what to do, how to put what I just talked about into action. And of course, James, you know him from AlphaShark. He's a trader and options educator. He actively trades the futures, equity options, and currency pairs and commodities. As one of the moderators of the live trading room, he actually educates members on strategies, trade setups, and risk management. He trades his own capital doing that. And Ramelli, he regularly appears on Bloom. You've probably seen him there. I've seen him before too. It's kind of cool to work with him. He regularly appears on Bloomberg TV, BNN, and CBOE TV. In addition, he writes a weekly column for Futures Magazine, and he's featured in CME Group's Open Markets as a guest contributor. He holds a BS, a Bachelor of Science in Finance, with a concentration in derivatives and financial engineering. It's always great to talk to. He's got so much information and knowledge. I always love our conversations. He did that from the University of Illinois at Urbana-Champaign. Contact him directly at James@AlphaShark Trading, and for me, contact at Corey@AfraidToTrade.com. James, I'm looking forward to seeing how we put this into action here with options and strategy. So I'll turn the mic and the screen over to you.
Thank you very much, Corey. So just give me 1 second here, guys, to bring up my slides. Okay. So what we're going to be talking about here is trading unusual options activity. And this is a way that I can take the concepts of looking for money flow and pinpoint the stocks that I actually want to participate in. Corey talked a lot about, once you've determined what the trends are, where you are in the business cycle, and what your general thoughts are on specific sectors, you then need to go out there and make a decision on how you're actually going to trade that. Now, you might trade that as a day trader, you might trade that as a swing trader, you might trade that as a long-term investor, but no matter what you do, you have to make a decision on how you actually are going to go about putting risk capital in play to take advantage of whatever type of trend or idea it is that you have. And my absolute favorite way of doing that is by trading and tracking unusual options activity. And we're going to talk about why I like unusual options activity so much and why it gives me so much information that I can't really glean from a whole lot of other places in financial markets. So I'm not going to talk too much about myself. Corey did a great job of introducing me there. Thank you very much, Corey. But my name is James Ramelli. I actively trade equities and equity options here at AlphaShark Trading. I was running around like a chicken with my head cut off today, trading this sell-off in the market. I had a really good day, though. Really enjoyable trading session, and I'll show you guys some of the trades that I had on today that were all based on unusual options activity. Like Corey said, I'm regularly on CNBC, Bloomberg, Fox Business, BNN Canada. I was on BNN in Canada earlier today. I'll be on Bloomberg tomorrow and possibly CNBC. I'm waiting to hear back from them. But I also write for a lot of different media outlets online. So if you've never seen me on TV, maybe you've read something I've written. If not, nice to meet you. So the whole idea of trading unusual options activity is to try and get a retail trader to have a success record that's more in line with what institutional traders get. 90% of all retail traders lose money. Right now, right off the bat, I know for a fact that this group that I'm speaking to right now is not going to be part of that statistic, right? You guys are more savvy traders because you're taking time out of your day to come here and learn more. That can't be said for the vast majority of people who are out there actively trading. But unfortunately, most retail traders struggle. Most retail traders lack direction, they lack a plan, they lack discipline, and it causes them to fail, and it causes them to get kind of inconsistent returns. But when we look at how institutional traders trade, they make money all the time. Right? And it's not just because they're using algorithmic black box strategies. It's because of the information and access that they have that retail traders really can't have access to. No matter what I do, I'm never really going to be able to compete with them on that level. So with that, I want to talk a little bit about unusual options activity. How many of you in here, just so I have a general kind of baseline of where we stand, have never ever heard the term unusual options activity before? Have you guys never heard it before? Have no idea what it is? So a lot of you have, right? More than just a couple people are saying that they've never heard of unusual options activity. And the more and more that retail traders get interested in derivatives markets, the more that unusual options activity is being discussed in financial media, in financial publications that cover stock markets and financial markets, because unusual options activity has been really on the kind of forefront of the latest rash of insider trading investigations, right? All of the insider trading cases that you hear about these days involve guys that are using equity options to take views in underlying stocks that they have inside information in. Now, that's part of unusual options activity. It's a small part of it, but it is really important to understand that a lot of the UOA that we see, they have some type of information that might not be publicly available when they put that trade on. Now, we're going to talk about individual equities, and then I'm going to touch a little bit on ETFs. But just so you guys understand, this type of concept works really well with the sector rotation model that Corey was just describing, because it points me to the stocks that the institutional traders are thinking have the best chance of moving or are the strongest or weakest in a given sector, okay? But the reason that I want to follow unusual options activity and use it to highlight the names that might be most in play is because institutions simply have more edge than I do. No matter what I do, I'm never going to be able to compete with them in any of these categories that I have listed here, and it all starts with capital. They have so much more money than I do, and even if I was trading with a $10 million account, my account would be dwarfed by the size of the leveraged accounts that hedge funds and institutions get to trade with on a daily basis. But the capital that they have drives their advantages in these other areas as well: manpower, technology, and information. So I know that when I see an order coming across the tape, there's been quite a bit of resources that were poured into developing the idea that, hey, we should come and buy these calls. But it all starts with capital. Manpower is another really big one too. How many hours do you guys think you spend outside of market hours in a given week doing quote unquote homework? Looking at charts, reading financial statements, reading articles about positions that you might have on, about companies that you might be investing in, coming to presentations like this one to learn a little bit more and hear some new ideas, right? Some of you are saying 15 hours, some are saying 10 hours, someone says, I really don't have time, not that much, right? And some people spend 40 hours outside of market hours. Unfortunately, even if you are spending that much time, you're never going to be able to compete with the amount of analysis that a team of quants at a hedge fund is going to be able to do, right? The technology that they have available to them also allows them to analyze vast, vast quantities of information. And even if I spent all week outside of the market hours poring over every piece of publicly available information, I'm not going to be able to do as deep of an analysis as an institutional trader is. But information kind of comes in two different ways for institutional traders. They have access to all of the public information that I have access to, just like all of you guys have access to that public information as well. Like I just said, the kind of funnel that they run it through is a little bit more intensive, and the analysis that they're able to do is a little more intensive as well, because they have so many more people, right? I'm always going to be limited by the fact that I'm just one guy. But another piece of this is inside information and information that is non-public. And a lot of trading and unusual options activity that we see is this type of non-public information. A study was done and pretty heavily reported on about a year and a half ago. They were talking about this on CNBC, and Andrew Ross Sorkin wrote a really large piece about it. A study was done that said that around 25% of all the M&A deals that happen in the year have some type of leading unusual options activity. So that what tells you is that when M&A deals go down, when there's a catalyst event on the horizon that shouldn't be known to the public, someone always knows, and a lot of the time, at least 25% of the time, they go out there and place a trade based on that information. So if I can't get that information, and I don't want that information because I'm not supposed to have it, if I can't do the same amount of analysis as them, if I can't have the same amount of capital liberties that they do either, then how can I hope to compete with an institutional trader? Well, what if I told you that all of this boils down to one thing that I can readily access, and that is their trade, right? All of the information that they analyze, all of the work that they do boils down to one thing, and that's a trade that they're going to come into the equity options market and execute with their risk capital. So if I can figure out what they're doing, what the trade is, well, then it doesn't really matter that I don't have any of this, right? Because all of the information that comes into here and comes out just turns into a trade, right? So someone asks, using Option Hacker UOA trades, how long after entering close to the UOA trade listing, do you exit the trade based on time to expiration and or the max time of stock move based on UOA? So that's a complicated question, and I actually have a relatively simple answer for it. If you just want to bear with me for a second, I'm going to go over the trading plan and how I actually pick my targets in a little bit here. But if I can get that trade, I'm able to benefit off of all that work and all those advantages that they have without actually having to be part of that system, right? And this is where we enter into unusual options activity. Unusual options activity is driven by institutional order flow, okay? Unusual options activity is an order that is above the average daily volume in a given stock. So it's pretty simply defined, right? If a stock normally trades 1,000 options a day and today it traded 2,000, that is unusual options activity. That's 2 times its average daily volume that were traded in a day, okay? But it gives me insight into institutional order flow, and it lets me see where the smart money is going. It lets me see where the big money is pushing their risk capital at any given moment, right? Corey talked a lot about how he looks at sector rotation, and once he has a decision on what he thinks is going to happen in a sector, in the broader market, how he then looks for ways to actually play that in stocks. Well, I look at all those same things, but the way that I decide what I'm going to trade is based on where institutional money is pressing their bets, right? So like on a day like today, I actually bought some puts today, right? A lot of people would look at me and say, what are you, crazy? The market was down 40 handles. Why are you getting short on the bottom? Well, I bought puts today because institutional traders were coming in and pressing their shorts in certain sectors that were seeing outflows as well. So when you pair those two things up, it's really easy to find the stocks that I want to be involved in, or find stocks that are going to be the most effective at expressing my view if I'm getting behind all of the institutional money as well, right? And that's what's really great about trading unusual options activities, that if I'm looking at flows in equities, I can either see inflows or outflows, right? With options, institutional traders are able to express a whole lot of different views, and I can use those views to glean information on what they think is actually going to be happening. And when we talk about momentum, we talk about trend. I want to trade with the momentum hedge funds, right? Because they're a big part of the participants that create that momentum. So if I can see where they're putting their risk capital, I see where they're adding to longs, where they're pressing longs, where they're picking up shorts, where they're trying to call bottoms and things, all by watching the order flow in the options market, I can use that, and that's an incredibly powerful set of information, right? Now, actually finding these trades, this is an example of what an piece of order flow might look like in equity options. And this is from a scanner called Trade Alert. And we offer one called Option Hacker that does the same thing, looks at order flow across all the exchanges and tries to find the most unusual block trades. But there's a lot of other places that you can get this information, whether or not you come and buy our scanner or use the one that is built into Thinkorswim or the one that is built into TradeStation to find it. Doesn't really matter to me. I of course think that ours is the best, but this information is readily available in a lot of different places because exchanges have to make it readily available, right? They can't hide their order flow in the equity options market. There are no dark pools. There are no centers of off-exchange liquidity that an equity options trader in the institutional space can go to hide their order flow. If they're going to put a big trade on, everyone's going to see it, and we're all going to be able to see all of this information that is pertinent to that trade. So take a look at an example here of profitable unusual option activity, and this is kind of show you guys what it looks like. PMCS, a trader came in and bought 15,000 or nearly 15,000 of the Jan 7 calls in PMCS for 85 cents. Okay, now this is a huge trade. It hit the tape midday against open interest of only 318 contracts, so it's obviously a very significant order. It's incredibly large. The order hit the tape, and we see right away that it's a $1.25 million bet. Now, based on that, how many of you guys think that this was an institutional trade, or what is the likelihood that this was a retail trader coming in and putting on $1.25 million in out-of-the-money calls in PMCS, right? It's not too likely that this was a retail trader. So right away, we know that this was some institutionally backed trader who came in and is putting a big chunk of capital. And you might not think that $1.2 million is a lot of money. And in the world of stocks, it really isn't, right? If a trader came in and bought $1.2 million worth of PMCS stock, we wouldn't even care. No one would bat an eye, right? But because they're doing this in derivatives, meaning that they have a little bit more or a different type of dynamic risk exposure, we know that this is an institutional trader, right? It's just way too large. But watch what happened 2 days after this order hit the tape. PMCS is announced. It is announced that PMCS is going to be acquired in an all-cash deal. Sorry about that. Kind of cut that off there. And the stock gapped to the upside. 2 days later, the calls exploded in value, trading as high as $3.33 in that session. You can see this is actually at the beginning of October. And the trader made $3.6 million in this trade in just 2 days. All right, so if a trader would have bought 20 lot of these calls, they would have profited $4,900 on $1,700 worth of risk. Now, this isn't really an order that fits into the mold of following momentum, right? What do you guys think happened in this particular setup? Did this trader just have a good feeling about PMCS and happen to get lucky, or did they know that this trade was going to go down? Did they know that this order was going to be worth significantly more money because a deal was going to happen, right? Yeah, they absolutely knew, right? It's really funny. Anytime I always ask that question when we talk about unusual options activity, and anytime I show an example of an M&A deal where there was UOA beforehand, I always say, well, what do you guys think? And it's really funny to see the responses. People sometimes say, maybe they did get lucky, but most people say the idea that they just got lucky in this trade and didn't know this was going to happen is almost laughable, right? So this is the type of order flow that when you add into the idea of tracking UOA, makes it even more worthwhile. Now, generally speaking, I know that when I'm looking for unusual options activity, this isn't the type of order that I'm going to see or trade all that often, right? It might happen to me if I'm lucky 2 or 3 times a year. Since I've been trading this plan and using unusual options activity, I've probably had calls in maybe 5 or 6 different deal stocks like this, right? But even though I'm using UOA as a tool to kind of monitor flow, I still understand that this gives me a whole lot of extra upside when there's a possibility that something like this might happen. When I see a big signal like that, a really suspicious looking trade, and I participate it and can get upside like this. Another really good example of this, is an order that happened earlier this year in Kraft. A trader came in and bought 5,000 of the Kraft June 67 half calls for 40 cents. When the market was 30 bid at 40 cents, sweeping all of the offers, lifting as many as they could so they could get filled in this trade. This was only one of a couple of orders that were equally as large that came across the tape that day in Kraft. But this order came across the tape on March 10th. What does this tell me? Right, so someone says, James, how far out will you buy these options? So anytime I see unusual options activity, I want to buy the same trade that they're doing. I don't want to try and tweak their idea, right? I just sat here and told you guys that I pretty much believe that institutional traders have the best read on everything. So if they went through all this analysis and all this work and then come up with an idea for the PMCS Jan 7s, well, I can most certainly come in and buy the PMCS October 7s for a lot less money. But that's not the trade that they did. So why would I even bother to look at unusual options activity if when they come in and do a trade, I'm just going to say to myself, well, I'll just change that around. I don't really care that that's the thing that they landed on. Well, they went through a lot to do that, right? So in Kraft, this order came across the tape with a bunch of other orders. And one of the things that someone's asking, how do I determine if it's a hedge or a directional bet? Great question. And there's a lot of different things that I can do. We're going to talk about those in a little bit here. So Kraft, the June 67 half calls were bought for 40 cents. This is a big bet, right? Even a 5,000 lot. And like I said, this isn't representative of exactly how many were actually traded that day. That's a $200,000 bet in out of the money calls in Kraft. Now, do you guys think that Kraft in general catches a lot of interest from derivatives traders on institutional level? Or is it a stock that's relatively boring? Is this a momentum name like Tesla or Twitter or Facebook that hedge funds are slinging back and forth all the time and putting on big, enormous derivatives bets in? No, it absolutely is not. Kraft is so boring. Kraft hardly moves. But that's what made this order so suspicious. That's what made it so interesting, right? Is that they came in and did this trade in a stock that really doesn't move that much. So then what happens? And we all know the Kraft story, right? Kraft and Heinz announced they're going to merge. Warren Buffett deal. The stock explodes to the upside on the news that they're going to pay a $16 special dividend to all of their shareholders. The new company trades under KHC, so this is an old chart. There actually is no more craft charts out there, but this is an enormous, enormous gap to the upside. This trader made about $40 million when it was all said and done in this position. Those things went from 40 cents to over $23 in about 2 weeks based on one big gap higher on this announcement. And again, it seems fairly obvious that, hey, this trader probably wasn't just getting lucky. He probably didn't just come in and throw on a big bet in craft and just so happened to see it move to the upside like that when getting lucky on the announcement. So as you can see, unusual options activity can give me insights in individual equities, but it can also point me to places where just momentum is at play rather than inside information. So why do I actually want to take these trades? Why is this where I'm looking to put my risk capital with these institutional traders? And it's simply because they have more information than I do, and there's really not a whole lot I can do about that, right? And I'm not talking necessarily just about insider information or non-public information. What I'm also talking about is information that they have, because of a more rigorous analysis process, because they have more resources than I do, and they're pretty much going to have those resources all the time, right? I'm not really going to be able to do too much to compete with them on that level unless I want to hire a bunch of PhDs from Harvard or MIT to do quant analysis for me, right? But it gives me insight into where these pros and these big funds are pushing their bets, pressing their bets. And I keep saying that because on days when the market is up, what am I looking for? Well, I'm looking for where traders are pressing their bets in strong stocks using equity options. I'm looking to see where traders are pressing their bets in weak stocks using equity options. And I'm also looking to see where they might be coming in and looking for hedges in certain names. A lot of the activity that I see on a regular basis isn't something that actually leads me to a trade where I'm clicking the mouse and buying a position. What it's doing is telling me, hey, keep an eye out on this sector, keep an eye out on these stocks, because someone out there is getting pretty worried. Like today, we tracked a lot of bearish activity, and I can actually show you guys. Corey showed you guys a heat map of all the different sector performances today. Well, I'm going to show you guys what our quote-unquote heat map looks like in our equity options world. And here we have unusual options activity flagged by our system called Option Hacker. And what do you guys notice about this? It's a lot more bearish order flow than it is bullish order flow. So the same information that Corey's able to glean off of those heat maps and that sector performance record, I'm able to glean off of the options order flow. So now that I know that, hey, equities, a lot of bread today, a lot of outflows, options, a lot of put buying, a lot of bearish speculative bets, or hedges being put on by equity options traders, I might want to be a little more cautious about getting long this market tomorrow. Okay, so all these trades are public information. So even if there is insider information that drives the motive behind a trade, if I see that order hit the tape, I then can use that information to do whatever I want with it, right? It's public information as soon as it hits the tape. The guy that did the trade might get in trouble if he knew something he wasn't supposed to, but I never will. All right, so that kind of brings us into the next part of my presentation. I'm going to go over a trading plan really, really quickly, so we have plenty of time for Q&A. But before I do, does anyone have any questions so far about anything that I just talked about? Any questions at all? If not, I will move on to the trading plan. And I should have said at the very beginning that I, would be more than happy to. How much is computer generated? So when we're talking about large block order flow in equity options, very little of it is actually generated by a black box model, right? They don't really do arbitrage strategies and that type of scale, right? Chicago is the home and headquarters of high frequency trading in the entire world, right? I have a lot of friends who play that game. I have a lot of friends who work for HFT firms here in the city. I do not. I'm not a computer science guy. I don't know how to code, right? If I did, I would go do what they do, because they have pretty lush lives, just sitting in front of their computers all day, watching their computer make money for them at their firm. But when we're talking about massive equity options order flow, like we saw in Craft, like we saw in PMCS, that's not driven by a computer model. That's not what is driving that trade. They might be, putting on plays based on what computers have told them to do, based on what their proprietary models have said is in play or might be a good value for them. But in general, large block equity options trading is still done by people. Okay. So someone says, to have enough liquidity for exiting a UOA trade, what would be a maximum percentage of the original UOA trade listing that one could buy or sell calls or puts? So that's what's really great about equity options, is that these are really liquid markets. They're way more liquid than you might think they are. And when we watch unusual options activity, you would be amazed at how many orders come across the tape in a day that are 10, 15, 20,000 contracts that the market maker swallows up no problem, right? They just take the trade and it's done. That's the type of liquidity that I'm working with. I mean, I really would be hard pressed to put on a position that was so big that I wouldn't be able to get out of it when expiration time comes or any time in between that. Okay. But let's talk a little bit about actually identifying the trades that are going to be the ones that I actually want to put risk capital into. So once I have an idea of what my general market thesis is, if I think we're going to be heading higher or lower, I need to figure out how I can best express that idea. And I'm going to do that by looking for unusual options activity. Not every single order that comes across the tape, however, is going to be an actionable trade. Like a lot of the questions have centered around here, there's a lot of hedging activity that goes on. Market participants in equity options are doing one of two things. They're getting long or short via calls or puts, or they're hedging long or short stock positions via calls or puts, right? So I have to figure out whether they're doing a hedge or a speculative bet. I don't want to buy their hedges. I want to be on the same side as the speculative trader. So we have a trading plan called the Oak Ribbit Trading Plan, and it helps me analyze order flow and hone in on positions that institutional traders are doing that I might actually be interested in trading as well. So this is what order flow looks like. And this trade actually happened on Tuesday. Okay, and it was in JCI. Anyone that wants to pull up the chart of JCI can see how this trade worked out before I even get to it. But a trader came in and bought 4,120 of the JCI D's 46 puts for 93 cents. All right, now on Tuesday, I had already seen a lot of bearish activity in the equity options market, right? There had been quite a bit of what looked to be either speculative bearish bets or hedges coming across the tape. So I already had a frame of mind that said, hey, you know what, maybe I want to pick up a little bit of short exposure today. That wouldn't really hurt me to do that. So I used the Oak Ribbit trading plan to determine if this JCI order that is unusually large is going to be an efficient way for me to do that, if it's going to be a way that I can actually use to get some short exposure. This is a pretty big bet, right? This is a December position. December expiration is about 15 days away, so about 2 weeks away. 14 days away, 2 weeks away. And this trader came in and bet about 385,000. That's a big bet, right? It's a big bet considering these are at the monies. So I have to figure out if this is a trade I actually want to do, if this is going to be something I can use to get short. So the D's 46 puts were bought for 93 cents against open interest of 184 contracts. The first step is to check whether or not open interest is smaller than volume. If open interest is smaller than volume and volume is greater than open interest, I know it's an opening position and I can move on with my analysis. If I can't determine for sure that it was opening, I'm not going to even bother to look at anything else, because why would I want to get into a position as a trader gets out of it? I have to determine with 100% certainty that it is an opening position. Think about this logically. If they buy 4,100 and open interest is 185, there wasn't 4,100 there for them to close, so it has to be opening. Also, this trade's labeled opening. More often than not, opening positions are labeled as such, but sometimes the broker forgets or just doesn't do it. Some exchanges don't have the provision to label them that way, so it's always worth double checking. And I want to see huge volume over open interest. So once I determine that this is a opening position, I can then determine whether or not I actually can use this trade to get short or buy short deltas to help get my book more short. And I'm going to use the Ichimoku cloud to help validate my setup and some very basic technical analysis. I'm sure that when Corey jumps back on here at the end, he can laugh about how pedestrian my chart reading skills are. But I like the Ichimoku cloud because it's easy to use. That's the reason that I like it, is because I'm not a technician, right? I never have been. I really believe that technical analysis is really powerful. I just don't have that type of knowledge. And so I need an indicator that I can use very easily to very quickly look at setups and determine what the overall trend is. Because when we're looking at order flow, I mean, it's flying across the tape all day long. I can't spend 20 minutes looking at one trade setup to determine whether or not I actually want to take it. So the Ichimoku cloud, for those of you who have never seen it before, it looks a little intimidating, right? There's a lot of stuff going on this chart right now, right? There's a lot of lines, there's a big shaded area, but basically all you need to know is anything trading above the shaded area is in bullish territory. Anything trading below it is in bearish territory. So all I want to see when I'm looking at a chart is that JCI is not in a rip-roar bullish uptrend that I think has no chance of breaking down. And when I looked at the chart when they came in and bought these puts, I didn't see anything that was necessarily telling me that this was an incredibly bullish chart. Take a look at the way that this traded that day, right? Huge tail or wick on the top of this bar, choppy consolidation around here, and they came in and bought a huge amount of puts, right? And this was on a day that the market was relatively flat. They came in and pressed their short as JCI was already looking pretty weak that day. Okay, so this chart doesn't do anything to kind of negate the bearish idea that I get from the order flow itself. So once I know that, I then need to determine how I'm actually going to go ahead and put risk into this position. So I have to measure my risk in one of two ways. I have a steadfast rule. I'm never going to risk more than 5% of my total book in any one given position. Now that might seem a little strict to some of you, but keep in mind that a 5% risk in equity options. If I'm risking, let's say I have 100 grand in my account, I risk 5,000. I'm usually risking 5,000 to make a whole lot more than 5,000. So there's no need for me to risk 15, 20% of my book in one position. I want to have as little variance as possible. So I do that by spreading out my risk. And I want to take at least a 4 lot. So I need to determine whether or not I can take at least 4 contracts and still have under 5% in total in risk in that position. And for me, this really isn't that much of a consideration, right? I have plenty of capital in my account. There really isn't going to be too many contracts that come across the tape that I can't take as many as I want of or a large amount of while keeping inside of that risk metric. But it's something that you really need to pay attention to if you don't have a whole lot of capital to trade with, right? Someone says, do you buy a minimum of 4 so that you can scale out? Yes, exactly. So that's exactly what I was getting to. So I buy at least 4 so I can scale out of the trade and then have the option to add back if it pulls back against me or moves against me after I've already taken profits. All right, but I keep my stop losses in mind when I enter the trade, and I calculate my stop losses based on option price. And this is a pretty simple calculation. If I'm a beginner who hasn't really gotten used to the idea of trading unusual options activity yet, I have to be really careful with my positions, and I can't risk too much money. So I'm going to use about a 20% stop loss. If I know a little bit more, I've been doing it for a little bit longer, I can risk more. If I'm an expert, I don't use a stop. And I don't use stops because I like to spot opportunities to add to positions if I can. It helps me keep my risk in line, especially in options that are more expensive. Right? If I buy an option for $3, it's $300 per 1 lot. If I buy a 10 lot of those options, that's $3,000 in risk. All right, it's not a small amount of risk, so I have to be aware of that at all times and keep stop losses in place. So time and target, this is a really important concept when trading unusual options activity. If I see an order coming across the tape, I want to take the same expiration as that trader, and I want to get out of that position if I see them selling their position. That's what's great about trading unusual option activities. When I see them enter, I just have to keep paying attention and wait for them to exit. If they exit before expiration, I'm gone too, right? The 44 strike puts are further out of the money. They might have been cheaper, but that's not what the trader did. And I said paper, that's a holdover term from the trading floor. Paper refers to really large block order flow. But remember, a lot of work went into them choosing that contract. So that's what I want to do. I don't want to try and fly in the face of their analysis because I know that it's really, really intensive. So JCI has been getting crushed since this order hit the tape. The puts traded as high as $3.40 in this morning session. I bought them with paper, so I bought them for 95 cents. And when I say I bought these with paper, I don't mean like with a paper money trading account. I bought them with the institutional trader right when he bought them for the same price. I bought these in my actual trading account. A trader who bought 20 of these would be up $4,900 on $1,900 in risk in just a few days if they held to the highs. I sold mine for $190, bought them for 95 cents, sold them for $190 the next day, and was pretty happy about it, right? Bad sale. They traded way higher than that today, but I can't really cry over spilt milk because I more than doubled my money overnight in this position, and I was led to this and got ahead of a big sell-off got into a position that really performed well in a sell-off because I saw institutional money pressing a whole lot of capital into this short position. All right. And exactly, I got out because I followed my plan. My plan called for me to take profits there, so I did it. I can't really get mad at myself that I missed out on, a couple thousand more dollars, but, that's okay. So with that, I know that was a lot of information to fly through really quickly there. With that, I just want to talk a little bit about how you guys can learn a little bit more about trading unusual options activity. You can take our unusual options activity on-demand workshop. And this is something, and we've never actually done an offer like this. This is something that we offer on our website for $497. It is a comprehensive workshop on how to read order flow and trade unusual options activity. And it goes over in painful detail everything you need to know about every little, kind of different dynamic you might see in order flow, and then how to react and use that information in your trading plan. But in addition to that, we're also going to include a 1-month subscription to our gold package, which is our trade alert service. So with that package, you also get both of our best-selling ebooks, twice daily email alerts and position updates on everything that we're trading, entries and exits from our trading room via text message and email in real time, twice weekly exclusive webinars and discounted courses. So you get to come to our webinar series. We have it only for members twice a week. You get to come. There are presentations that are like this one about a range of different topics. We have 5 different presenters that present in that series on a regular basis, all from different backgrounds, all bringing different information to the table. All of the access to our members-only videos on the members-only section of our website, and both of our best-selling ebooks. One is about that Ichimoku cloud that we just looked at, and then another is a little bit more about a handbook on unusual options activity. So it's a fantastic value. We're offering it for $99. If you go to our website and tried to put this together, it would be over $650. So please check this out. It's a really great way to learn more about unusual option activity and then kind of get some real-time information associated with it via our alert service and the gold package. All right, so any questions that you guys might have about that? I want to go right ahead and bring Corey back on here to open up the floor for questions that you guys might have for either of us.
Hey, James Corey, I am back.
How's it going, Corey?
Good.
So thanks, great seminar, got to run. Thank you, Brian. You have a good one. So just kind of, we typically, when we do these kind of joint webinar types of events, like to have this end part be a little bit less formal, and you guys just kind of ask whatever questions you have. If you don't have too many questions, Corey and I can just kind of chat about some of the stuff that we just went over with, but I'm sure that you guys got questions. There's still a lot of you here, so please feel free to send any questions that you guys have. How many trades do you act on each month? That's a great question that we can both answer. So Corey, you want to go ahead and take that away?
Well, in terms of swing trading, my retirement accounts and longer-term portfolios, not much. If things shift, I'll do that, but 2, 3 per month on that frame. On day trading, I can do up to 5 to 6 per day. If a trade day, I did 7 trades today. Shorts on the market on the S&P futures down. So my trading activities dependent. I just focus on S&P futures. I kept it simple. Didn't look for stocks. Just the market's going down. I want to be part of it. I want to shorts on to it. So 7 trades today. Again, ES futures. But at range day, I might be less. Well, I will be less active. And looking for opportunities. I would say on a good day, 3 to 5. On a day like this, 7 to 8, 9, 10. But I try to keep it simple in my trading.
Yeah, and I like how you kind of talked about the difference between your investment and swing trading type of setups versus your day trades, and that's kind of the great thing about the way that I trade too, or the thing that I like the most about our strategy and plan is that it allows me to kind of participate in all of those different types of trades. Corey talked about how you can use sector rotation to set up long-term trades, set up swing trades, and set up day trades, and unusual option activity can guide me into setups across any of those types of time frames, right? If I'm looking for long-term trades, I'm looking for really long-dated equity options that are being traded, 6 months from now. That sets me up for something a little bit longer term. If I'm looking for swing trades, I'm looking for stuff that's with expiries, 2 or 3 months out. If I'm looking for day trades, I'm looking for stuff that expires this week, right? And whatever view I have on the market, I can look for the trades that lead me to that. So it really kind of depends on what the type of market activity is like, and it kind of depends on what my overall view is, right? So, on a day where the market is flat, like, last week, was a holiday week, right? It was a shortened week. So on Monday, I knew that, hey, we're probably not going to see a whole lot of action today. So I'm really only going to be taking orders that are longer dated. So on a day like that, I'm trading a lot less. Today, I took 10 trades, right? Because there was a lot going on. The market was moving a lot, and there was a lot of weekly option activity. So it all kind of depends. And it depends on what type of trader you are, too, right? I always tell people, and I'm sure Corey would agree with me, you have to figure that out for yourself,
Yeah.
what you're most comfortable with. We had a member of some of our services who called me up on the phone one day and said, hey, I really love everything you guys are doing, and I'm actually making a lot of money, but I can't sleep at night because I have so much risk on. Like, I just can't do it. I'm like, then you're trading too much, right? It's about trying to find what makes you most comfortable, and then that's going to kind of set up how many trades you take, right?
Yeah.
So any other questions at all, guys? So Corey, when you're looking at day trade setups, are you also kind of actively looking for those other like longer term trades as well?
Yeah, absolutely. It starts. I'm a top-down trader, and that's just from my experience back in the late '90s with the bigger market, the bigger picture. I look at what's called the narrative, and the narrative is what's pushing the markets, Federal Reserve policy, what sectors. Same thing with sector rotation. So the bigger picture, and everything flows down. So bigger picture in terms of where my portfolio needs to be defensive, offensive, and of course that's different than trading. It's more investing. But trading, yeah, if there's a swing trade, I will be involved in that. I do it straight up with ETFs and sometimes with stocks. I don't do options necessarily. I did that in 4 and 5. I just felt just personal. We're all different again, but I should go ahead for the underlying vehicles. Just again, ETFs make it simple. And on the intraday level, that's still based upon my bigger picture, the trend in the higher time frames, key levels in the higher time frames, and what's driving the market. Right now, it's Fed policy and deflationary trends, all those sort of things, and a central bank policy mainly as we transition at the end of the year portfolio. It's just bigger picture concepts, and I'm going to play that down to the lower frames. So, and I tend to set up a dominant thesis, what I think should happen. In the membership reports, we do that detailed, and an alternate thesis, what shouldn't happen. And sometimes, I'm sure we're all aware, bigger moves in the market occur when something shouldn't happen, when it surprises people. So I want to be there to take part. That happened on the bullish move, I think it was Tuesday, and then the bull trap reversal on Wednesday. So I want to be there to capture those big moves on an intraday basis, but in the context of money flow, the salient trends, and the narrative of what's moving the market.
Right, exactly. And I kind of approach things in a similar fashion. Everyone right now is very concerned about the rate hike, the timing of the rate hike, whether or not it's going to happen. So for clarity on that, what I'm looking for is equity options order flow in regional banks, right? Because
Yeah, absolutely.
that's going to be a sector that is going to be massively affected by whether or not they raise rates. So what I want to know is, hey, this is something that you hear, 10 people screaming about on CNBC every single day. Everyone has a different opinion, but what is actually being done in the market with risk capital from big institutions? And I can tell you that right now, I mean, we're looking for order flow on a daily basis. They haven't really made a move yet. So
Yeah.
I don't want to say that they don't know what's going to happen. I'm sure the institutions have their thesis already. They just haven't acted on it yet. So that means that I'm going to hold off too. Is it worth learning the Ichimoku Cloud Indicator if you're already a good chart reader? I mean, I think it's a really great indicator. I'm sure Corey could probably comment a little bit more on that, but we're very big fans of the Ichimoku Cloud here. We use it because we believe it has some pretty good applications for a lot of different products. It has some good applications for day trading, swing trading, and long-term trading, and it lets us kind of confirm trends on multiple time frames and gives us a lot of levels of support and resistance to work with. Are you a fan of the cloud at all, Corey?
That's what's weird. In trading, I've done a lot of things, but the cloud is something. One of my colleagues is Manesh Patel, and of course Hubert Centers, people that do the cloud in terms of their analysis and their public trading. But it's not something that's spoken to me. I'm more, if it works, it works fine. I don't poo-poo or discourage any type of analysis. If it makes money, if it prevents you from losing or maximizes your risk profile, absolutely. It is find the trend for me and get involved in that trend. So it can be as complex as deep level Elliott wave planning, Fibonacci projections. I don't do that as much as I used to a few years ago, but the more I've gotten it, it's weird. The more I've learned, the more simple I've become. My trading was doing well, but I got involved in the CMT material, and my trading actually suffered because there was so much material I was learning, so much about things I didn't know about. So when I actually tried to apply those in the real world, I wasn't familiar. So I had to sort of pull back with education and get back to what was making sense and simple. So it's been a constant battle between too much information and these flashy new indicators and flashy new things and what works. Ichimoku is good in terms of trend analysis, and that's why I would hold to that. Whatever helps you to get involved in a dominant trend, I think helps any trader of all levels. What tends to call for reversals, I've never really done well, never seen a whole lot of people do really, really well doing specifically reversal strategies. So TA is just looking at key levels, looking at indicator signals, strength, weakness, targets potentially, and going from that. It can be as simple as a trend line break in terms of chart reading. It doesn't have to be complex at all. And I think simpler tends to be better. So if the Ichimoku helps, 100% use it, yeah. It's not something I've done myself.
Yeah, and I mean, the reason that I like the cloud a lot is because it is pretty simple, actually. It's just a set of moving averages. It's, not really making any projections. It's never going to tell a trader that they should be buying lows or selling highs,
Yeah.
or trying to buck what is an already established trend. And I really like it because, like I said, when I'm looking at orders coming across the tape, there might be 1,500, 2,000, 2,500 trades that hit the tape in a given day. Of all of those, there might be 100 that are worth a second look. So I have to do my analysis pretty darn quickly. And I like the cloud because of its simplicity and kind of ease of use in that. The actual, and I learned this from Manish, the translation of the cloud, it's actually in long form Japanese pronounced Ichimoku Kinko Hyo, and the translation is one glance equilibrium chart. So it's meant to be something that you can look at one time and have a basis of general trend and direction really quickly, which is why I like it.
Yeah, we align on that sense in trend. It all comes back to trend, just complicated or simple. I think trend is the key to everything we do as traders, in my personal approach.
Yeah, and that's what is something that I try to talk about a lot when we're watching order flow during the day, and that's that institutional traders, they know that too. That's generally how they think as well. They're not coming in and trying to call the bottom on a stock that has been making 52-week lows every day for the last week, right? Every single time I see a large block of puts being bought, someone says to me, "Hey, they're probably, what if they're calling a bottom, they're buying the puts and buying stock?" Yeah, I mean, they might be, but typically speaking, if they're buying $1 million worth of puts, that means that their stock position would be enormous. And generally speaking, institutional traders are not trying to fight trend like that.
Yeah, absolutely.
Can you apply UOA on day trading? Absolutely, yeah. I am day trading usual option activity all the time. All I need to do is look for the more short dated order flow. Like weekly options is something that will guide me into day trades, and then I can set up positions where I have a lot of gamma, I have a lot of exposure because they're short dated, and I can get returns that are a little more difficult to get in equities in terms of percentage returns. But yeah, there's a lot of applications for UOA because hedge funds trade it all, right? They're going to trade options that expire tomorrow. They're going to trade options that expire next week. They're going to trade options that expire in 2018, right? So I can kind of fit my trading plan around what order flow I'm given to work with. Makes sense, info overload. Yeah, there's a lot of information to go over there in about an hour and 20 minutes, but that's why we record it.
Especially on the charts for this. I recommend highly on the webinar recording. Look at the ETF positions and look at that and build out a strategy from that. Because there's not enough time to go through all the symbols and all things from that. So that it's the webinars are really helpful for the record.
Right, absolutely. And so I wanted to talk a little bit about ETFs as well. We looked at examples of UOA in individual equities. It happens in ETFs as well, right? We saw a whole lot of put buying in the XRT at the beginning of the week. And while it kind of looked for a while like that trade wasn't going to work out, and it wasn't working out for a while, they came in on Monday and they bought all of these puts. I joined the trader that bought them. They bought this week's 44 strike puts for 30 cents. And it looked like the trade wasn't going to work out. The XRT was stagnant to slightly higher. And then today, it really paid off, and I was able to sell all of them for 52 cents, got my money back, and then some. So there is opportunities to follow UOA and ETFs. And actually, one of the things that we do is try and pair up fund flows with unusual activity. And it's something that, and I know that Corey said that he kind of looks at sector rotation and then will pick individual equities or ETFs. How often would you say you kind of express views using individual stocks versus ETFs?
Well, probably on a weekly basis, 2 to 3 times a week, and it's usually names that we've heard of, Google's, Apple. So I still have a little affinity for those big name stocks, so I'll do that. But mostly I'm not going to do things in utility stocks. I'm not going to buy utilities. I'm not going to buy healthcare stocks for the most part. So it would be typically on technology, financials, to an extent industrials, and maybe energy, but my activities that I do for swing accounts is in certain sectors. I'm not just looking at applying the model directly. There's certain affinities I have to stocks or different groups of sectors just from experience and 15 years of doing this. I'm used to certain things. But a swing trade would go anywhere from 2 weeks to a month or so. And these trends, like I showed in one of the slides, they tend to last. Things that outperform currently probably will outperform in the future. So I want to be dipping my account a little bit here and there in the swing account into some of those names. If not just the ETF, which makes my job a lot simpler. It's not so much being lazy, but just being not worried about individual risk of a stock risk. You're doing sector risk. So it's market risk, sector risk, and individual stock risk. So I would prefer just to stay in the ETF level, but just for fun, keeping my job interesting, because we don't want to get bored of what we do. I tend to play into Apples and Chipotle's and things that I'll talk about in the blog or membership. So I will do individual stocks, but as a swing for the most part. I'll day trade with futures.
I see. I would say that the majority of my positioning is in individual equities because I'll develop a view on a sector and then we'll look or wait for some type of order flow that would tell me that institutions are kind of feeling the same way, or I'll notice trends in order flow in an individual sector and then we'll look at the order flow that's coming across in individual equities. That is I don't want to say that trading, like how Corey said, it's not being lazy. I wait for the trades to happen and wait for some institution to make up their mind, and then I'll trade. But there's different ways to express different views. Sometimes I do ETFs, sometimes I do stocks. It kind of depends on the way the order flow comes across. If I see them coming in and buying just a ton of puts in the XRT, and then I see put buying in individual components of the XRT, well, then I'll say to myself, okay, well, which of these gives me the best likelihood of success given the information that I have. So, I'll take a look at the charts and all the different names that I'm seeing flow in. If one looks weaker than the other and I'm trying to get short, well, then that's going to be the one that I go with.
Yeah, exactly. Or if it's set up in I do a lot of retracement trades, flags, bull and bear flags. If there are 5 stocks in a sector that I want to get short or want to get long, and 2 of them are there's just no risk reward. There's just nothing to trade, but 2 of them have good setups, like a retracement or flag to a key support level. I'm going to trade those 2 because the risk is defined, the target is defined, and the setup is clear. It's repeatable. We know what a bull flag is. We know what a whatever the case may be, breakout or triangle or something, but something that in the sector, that's what I do in stocks, having a pattern in the sector, I want to take my risk with stops and targets and go from that. So that's what's helpful as well, is getting the bigger picture, drilling down, and then finding a specific low risk tight stop and relatively high target setup.
And that's exactly, that's the name of the game. A low risk, high target setup, and that's exactly what makes me a big fan of options. Is that I always know what my risk is, no matter what. So, if I buy XRT puts on Monday that expire on Friday for 30 cents, well, I know that I'm short XRT this week. If XRT rallies $500 a share, I'm still only going to lose 30 cents.
Yeah.
Option has a built-in stop.
I
But
do like that aspect of options, though. I've always liked that, but I've just, to me, it's so much information to take in. So I just stay with the ETF itself. But yeah, that's having the defined risk is a very, very big advantage of option trading.
right, absolutely. And there's a lot of dynamics that go into options trading, right? There's a lot of stuff that is is kind of at play at any given time. A lot of traders that are have never traded options before don't understand that it's not just about the direction of the stock, right? I can't tell
Right.
you how many traders come to me and say, you know what, I don't understand why anyone would trade options. All I do is buy calls in stocks that go higher, but I keep losing money, right?
It
And
happens,
that's
yeah.
happened to everybody, right? That has
Yeah,
happened
me
to
too.
absolutely everybody who's traded options. It's happened to me all the time. Um, but you know, when I'm basing all of my decisions on institutional order flow, it kind of takes away a lot of the importance of some of those other factors. I don't necessarily need to be concerned quite as much about my, gamma exposure in a position when I know that, there's a reason other than, implied vol levels that I'm taking the trade. I'm taking the trade because someone bet a couple $1 million on it.
hmm And chasing their money flow, chasing their trail of activity and profit from it. Just capture a little bit of movement from their activities as well.
Exactly. So, Corey, do you differentiate and demand supply and demand levels on charts as different from support and resistance levels, and base your entries and exits on one or the other of those levels?
Yeah, not necessarily. In terms of what I do, support resist. The question's on supply demand levels and support resistance. I do things in terms of accumulation, which is going to be positive divergences in volume, momentum, or something else, internals, off of a support level, and then distribution would be resistance levels. But you're seeing negative divergences, negative volume, and those sort of things. But supply demand to me are concepts. They're not so much theoretical, they exist, but it's supply is going to be selling pressure, demand is buying pressure. But there's indicators to show that, to show kind of aggregate volume. But in terms of support resistance, a lot of what I do is that. The euro, I did a post on the euro this morning with respect to a major, major support level and a big rally up off of that. So you can call it supply or call it demand rushing in, but it's just to keep it simple, once again, it's a buy off support with positive divergences. So I'm focusing on usually price moving toward or away from a certain level. For example, the S&P 2100. That's what I discussed in the Monday market panel and then Tuesday market update with TradeStation. The market is at a key level with divergences, and it should, dominant thesis, be coming down. And Tuesday was a little bit of an off day because it jumped up. But then Wednesday and Thursday, today and yesterday, were big down days. So after a little bit of a even stronger divergence, the market moved violently 2 days in a row, 2 trend days in a row, down away from 2100. And that's resistance. So be it gold, at 1100, 1080 not too long ago. Oil at 42.50, oil at 40. Just keep it in terms of price levels and movement toward or away. And a lot of times, traders in both directions, or funds for that matter, will get trapped. If there's a support level that breaks initially and then rallies back up, that's a trap. So that's where I want to be interested in stocks more than ETFs, is if there's a major failure outcome. And that's going to lead to a big move. So I don't really, again, in terms of my personal supply demand or theoretical concepts, I don't look at an indicator called that necessarily, but I'm looking at key price levels. And yeah, I would call them support resistance levels. And my trades would be dipping down to a lower frame. So 5-minute chart particularly, or 30-minute chart, something based on a higher time frame. Key, critical, obvious, we all see it, and we're all going to react to it. And then as James was saying too, we just trade in that direction with the big funds or the big price movement.
Exactly. So I think that kind of brings us near to the end of the time that we have here. So if maybe we can each answer one more question, and then I'm going to do a real quick overview again of the offer that we have, and then I'll turn it back to Corey so he can do the same, and then we'll kind of wrap it up if that works for you, Corey.
Absolutely.
So any other questions that you guys might have? I guess here's a question for you, Corey, so I'll just throw this one to you first. What do you use to determine divergence?
Yeah, thanks, Joe. The question on divergence is, for a lot of what I do is confirmation, not real quick, is confirmation, non-confirmation. So a trend in motion tends to continue unless it reverses with, and the signals that would be reversing is a divergence. Volume is the most obvious. Momentum, I use Linda Raschke's style of 3-10 oscillator, which is the difference in a 3 and 10 simple moving average. Same thing is just, it's analogous to a rate of change indicator or indicator called momentum. No difference there really. You're looking for a price high, price in an uptrend making higher highs, yet this indicator, volume, momentum, or if it's intraday, market internals, particularly tick and NYSE breadth. Those sort of things would be confirming or non-confirming factors, but that's, I guess, the three I would usually is volume on a stock position, internals on an intraday trade, S&P futures, Dow mini futures, internals specifically, and then momentum across the board, being that difference in a 3 and 10 oscillator. So positive, negative divergence signal a probable reversal. If you're seeing momentum, volume, internals spike up with price in a trend, favors continuity of that trend. But yeah, volume, momentum, indicator, and internals.
Thank you very much. So with that, I'm going to go ahead and do one quick overview again here of what we have to offer you guys. So we're offering our How to Read Order Flow for Unusual Options Activity course on demand. This is a course that we regularly sell for $4.97 on our website. We're going to offer it to you guys now for a huge discount. We're also going to throw in a 1-month subscription to our Gold package, which is regularly $170 a month. It's actually the first time that we've ever combined these two things into one offer. So it's definitely a lot of value. I highly recommend you guys check it out. Like with all of our products and services, if you guys come and check this out and you decide that you don't like it, the course didn't really teach you what you thought it would, one, I'd be pretty shocked. There's a lot of information in there for $99. I want to say that you get about 8 hours worth of recorded material in total. And if you decide that the Gold package alerts aren't for you either, then you get a refund, no questions asked. That goes for all of our products and services because we know that they are of high quality. We work really hard to put this stuff together for you guys. So please check it out, alphashark.com/trading days, and you will be able to get this offer as soon as you make your purchase. The link to watch the recording is sent to you right away, so you can start going over this stuff as soon as you make your purchase. And you have it forever. You'll never lose access to it. You can go back and reference it as many times as you want. So it's definitely a really great value, and I hope you guys take advantage of it. So with that, I'm going to go ahead and turn it back over to Corey so he can do a little bit about what he has to offer you guys, and then we will bid you all adieu. So thank you guys all very much for your time and for coming here today. I hope you guys learned something. I know that a lot of people are saying it was a lot of information, but that's why we record it, so you can go back and look at it later. It is a lot of information. So thank you guys very much. Everyone have a fantastic evening, and as always, happy trading.
And again, thank you all. It's so good to be here. So glad to take part. And it was good with James and I's interaction in terms of the money flow and sector rotation, how to actually do that. So again, moving from concepts and trend to actual execution thereof. What I do in the open blog, which is free for all, just come and see what we're looking at. I do stock scans. I do educational components. That's at blog.afraidtotrade.com. And from there, you have access to daily scan, sector rotation, insights. But as a member, you get a lot more detailed. We do about a 10 to 12 page report each day, and that's talking about the main things: money flow, goal. We look at other things as well, and develop trading plans specifically for the next trading session. What's the dominant thesis? What's the alternate thesis? What should be happening? What are we going to watch the next day? How do we trade these things? So that's for you, for members, beyond the free open blog, and these are at premium.afraidtotrade.com. Also, a weekly planning report is about 20 or some odd pages each week there. That sets up the next week. That's where you get the sector rotation, the scanning, the money flow, bigger picture, any type of stocks we're looking at. That's where the weekly report will gather those for you. In addition to 2 full months of membership where you can see all that we're going over, take it through December into January, we'll give 10 lessons. That gets you started. There's 2 lessons that are specifically on sector rotation, trend reversals, accumulation, distribution, bigger concepts, momentum, divergences, all the things we use and talk about at Afraid to Trade on the open blog or the membership. That's going to be inside the lesson plan for you, and you'll be able to access that as well with your purchase. And the URL is just kind of quick, made it short, is tinyurl.com at member December 2015. The other link is going to be through the email, which is going to be an Infusionsoft direct member and lessons bundle. It's normally $525 doing this premium full membership and these 10 lessons, but I wanted to, again, thank you all for attending at the end of the year here in December. Great time to get more education, get more strategies and signals and all things for you. That's going to be $97. So email me at, just for any other questions, direct at Corey@afraidtotrade.com. Otherwise, free blog at afraidtotrade.com. And all the information for you is at premium.afraidtotrade.com. Otherwise, Twitter @afraidtotrade.com. So again, thanks to James, thanks to everybody at Alpha Shark, everybody that attended this presentation, had a lot of fun. Definitely be safe, manage your risk, but go for opportunities. Follow the trend, have fun, make this a fun thing. It's our hobby, it's our passion, and for a lot of us, it's our job and career. So have as much fun as possible, manage your risks, you'll have a long life in this trading business. Thanks for attending. We'll be at the lessons real quick. Terry asked, the lessons are each about 25 to 30 pages, and I'll be adding video components into January. You'll get those as well. If you buy this lesson today, you'll have the updates for life, and the videos are coming up at the beginning of the year. There's fresh videos for the new year in terms of the concepts, the lessons, the strategies, trend, how to buy retracements, the trading tactics, how to buy flags, how to buy breakouts, how to identify a trend, how to confirm a trend, momentum indicators, volume divergences, all those sort of things that get you a sense. It's not complex. It's not a deep level Elliott. It's actionable, real world, how to put these things into motion, how to trade, how to manage risk, how to set targets, etc. Within the context of bigger picture concepts, narrative, trend, money flow, works with options, works with ETFs, stocks, intraday short-term trading is the focus. Not so great for investing, but I focus more on intraday short-term tactics for you as well. But each one's about 25 to 30 pages and they get updated in terms of how new examples, new stocks, new things change. My gosh, Google changed over to Alphabet, so I got to go back and update my Google examples in my reports here. But nonetheless, that's all available to you. But again, thank you to James, everybody else here. If any questions, let us know, both James and myself, Corey@afraidtotrade.com. Otherwise, James@alphashark.com. And they're PDFs. So PDFs, and there'll be videos as well. PDF versions. They can be Word documents on request if you don't do PDFs, and of course, videos will be available too. So Corey@afraidtotrade.com and James@alphashark.com. Thank you all. Be safe, and we'll talk to you later. See you soon.